the adjustment process. So we will learn the concepts and guidelines that relate to the adjusting process. Why do we need to make adjustments? What are the adjustments? How do we make them? We'll learn some of the common adjusting entries that you're going to start to see over and over throughout the chapter. So hopefully they become familiar. We'll learn how to post these adjusting entries to the journal. And then, of course, everything that gets posted to the journal gets copied over to the ledger. We will learn how to make the adjusted trial balance. Who can tell me what was the process for making the unadjusted trial balance, the one that we worked on? How did we make that trial balance?
Is that totaling up all the balances in all your accounts?
That's it. You just take the balance of every account from the ledger, you put them in one document. Some have debits, some have credits, and those debits and credits should equal, right? That was the unadjusted trial balance. The only difference between that and the adjusted trial balance is that in between you made some adjustments. But the process of creating the trial balance is exactly the same. And then we will make financial statements. We've done some of that already, so that's really not going to be anything that's new. All right. Well, we're familiar with GAAP. GAAP, again, stands for what? Very good. Generally accepted accounting principles. And that's what we are focusing on. Some multinational companies use the International Financial Reporting Standards, but most American companies use GAAP, right? And we know the revenue recognition principle and the expense recognition principle that are part of GAAP, right? Let's refresh our memories. What was the revenue recognition principle? When can we count revenue? Yes. Well, not exactly when you make a sale. At the time the customer acquires your product or service. Yes. So once we provide the product or service to the customer, then we can count it as a sale. Wait a minute. You were right. It's Monday. Actually, both are true. It's when we make a sale, whether or not we've been paid, we count it as revenue. But to make a sale, you do have to provide a product or service. Both were true. Is there any question on that? Okay. Then the other question, the expense recognition principle. When can we count an expense if that expense was related to making our products? What point can we count that as an expense? So when we sell the product. Exactly. Exactly. Until that time, what is it considered? It's an asset called inventory, right? So we made the product, it's something we own. Once we sell it, then we can count it as an expense. So those are the revenue recognition principle, and then the expense recognition principle, also known as the matching principle. Okay, and that's why we need to make adjustments. Because sometimes there's a transaction that happens where the event, for example, the sale, and the dollars changing hands happen at different periods. So then later, you have to make an adjustment. Okay? So all of these examples of adjusting entries that we're going to learn about, they all have to do with that separation in time between what is the action or event and when the money changes hands. Okay. What's on here? Let's see. Oh, yes. The only thing I wanted to point out here, there's something called a 10Q. Anybody know what a 10Q is? Don't expect you to necessarily, but no. So the Q stands for quarterly. So this is the statement that a corporation is expected to file every 3 months. That includes their financial statements for that 3-month period. Okay, and 3 months is a quarter of a year. So in the business world, they usually just refer to a quarter, meaning 3 months. So your 10Q is your financial statements for the last 3-month period. Where does the company, the corporation, need to publish its financial statements? Anybody know? They will usually put them on their website, but they also need to send them to the Securities and Exchange Commission, the SEC. And later in the course, when we do a course project, we will learn to use the SEC's database to be able to pull up financial statements for corporations. Okay, so 10Qs are quarterly statements. And okay. And do you remember the time period assumption? The time period assumption told us that financial statements can be for periods less than a year. You could do a financial statement for a quarter or a month, or really for whatever time period you want. The official ones that the corporation has to produce are the quarterly and annual financial statements. The companies sometimes like to see monthly financial statements, just for their own purposes, to see how they're doing every month. Now, there is a difference for a lot of companies between the calendar year and the fiscal year. The calendar year that we use here in the United States goes from January 1st to December 31st, right? So that's the calendar we're all used to, sometimes referred to as the Gregorian calendar. But a company can start their year for accounting purposes at the beginning of any month they want. So let's say, just because of the seasonal nature of my business, it makes more sense to start the calendar year in March. So then my calendar year would go from March 1st until the end of February. Or like here at Hartnell College, because our academic year basically includes the fall semester and the spring semester, our fiscal year goes from July 1st to June 30th. Okay, so every company can start their fiscal year whatever month they want. You start at the first day of the month. You don't choose the day, but you do get to choose the month. So keep that in mind. Most of the exercises and problems we're going to see, they use the calendar year. But if it talks about a different fiscal year, then that's what it means. Okay. So that's pretty much it. Are there any questions so far? Yes.
So with these, this is when you're looking at a company that's created, right? Not just a small business.
Well, every business has a year-long cycle that it would use for its accounting purposes. But if you're, let's say you're a sole proprietorship, then you don't send your financial statements to the SEC. That would be the difference. They only require corporations to send their financial statements.
So all corporations send them in. It doesn't matter if they're publicly traded or private.
I believe that's true. So if there's a privately traded corporation, meaning that their stock is not sold on stock exchanges and you can only buy the stock directly from the company, which would mean only a small number of investors would be allowed to buy directly from the company. I believe that they still have to submit their statements to the SEC, but they don't have to make them public. But if anybody knows for sure, let me know. Or maybe if I remember, I'll look it up during the break. But definitely, if you're publicly traded, then you have to send your financial statements to the SEC. Okay, so good question. Any other questions? All right, so here we see the 9 required steps in the accounting cycle. Again, last week we really focused on the first 4. Identifying and analyzing transactions, the journal, the ledger, and the first trial balance, which is unadjusted, right? And then this week, we will be learning about the adjusting entries, the adjusted trial balance, and the financial statements. Then we have only 2 more required steps to go. But of course, there's more to learn, right? But at least we will know the full accounting cycle after next week. Okay, again, these are the 3 steps we will work on this week. All right, so let's see. Discuss the adjustment process. Okay, again, there are accounting stuff videos you might want to check out for this topic. So here's a scenario. In January, you prepaid your rent from 6 months. For 6 months. We all do that, right? We all pay for 6 months of rent at a time. Kidding. I think most of us do not do that. But let's say you did, and you paid $6,000 for 6 months of rent, right? So obviously, it's $1,000 a month. Well, you have the right to use that property for the next 6 months. So that prepaid rent is considered an asset. Right? It's not something physical, but it is something you own. You own the right to use that rent. Now, each month, you use up one of those 6 months, right? So after January is over, you've used up $1,000 worth of that prepaid rent. That's when you would need to make an adjustment. The amount of prepaid rent would go down by $1,000, right? Because you used up 1 month. And that is an asset that's going down. But we know that in our bookkeeping system that we use, the double entry bookkeeping system, we need to record at least 2 different accounts. What do you think would be the other account that we would use when our prepaid rent goes down? Rent expense. We can now that that time has gone by and we actually used it, we can now consider it an expense. Right? Because on January 1st, it wasn't an expense yet because even though we paid for it, we hadn't used it. What if all of a sudden our landlord kicked us out? Maybe we never got to use that prepaid rent, right? And it never became a rent expense. We would want our money back, right? But you can't really count something as an expense until it's actually happened. So this would be one example of an adjustment. Same thing, I think, did I mention how supplies are an asset, but when you use them, they become an expense? Or like I was talking about with inventory. When you have a product to sell, it's an asset. Once you sell it, then you count it as an expense. So these are all examples where we would have to then make an adjustment to turn that asset into an expense. Right? So what questions are out there?
Would you make that adjustment at the end of the month, of that month, in January?
Yeah, so technically it would be the end of the period. So for the company, whatever period it's using for its financial statements. But yeah, a month is pretty common.
Oh.
Mhm. Yeah, so it would be after that month had ended, then you go in and make the adjustment. All right, good. So let's see. We have to make these adjustments to make sure income statement and balance sheets present the correct up-to-date numbers. So let's go back to the rent example. Remember, we said after a month has gone by, that asset of prepaid rent has gone down, but our rent expense has gone up, right? Which financial statement does an expense impact? Income statement or balance sheet?
No, sir.
Income statement, right? Income statement is revenue minus expenses. So we see that the income statement would be impacted by that expense. What about assets? Which financial statement do those impact?
Balance.
The balance sheet. So the balance sheet would be impacted by the asset of prepaid rent going down. So with each adjustment, we're going to see that there's one income statement account being impacted and one balance sheet account. Okay. That's just the nature of how adjustments work. So then, of course, we'll have to do the adjusted trial balance after we've made all those adjustments and make sure our debits and credits still match. We wouldn't want to do this on a daily basis. Could you imagine if every day you had to count, oh, that's one more day of rent I used up. Oh, one more day of rent. That would be way too much work, right? So that's why typically it's just done at the end of the period. Here are some examples of other expenses. Depreciation would be one, and insurance. So depreciation, we've mentioned a little bit. That's when you purchase a long-term asset, that's how you turn that into an expense, is through depreciations. We'll cover that in more detail later. And then insurance. When you buy an insurance policy, it's typically for a one-year period. And for companies, when they buy insurance, they usually pay for it in advance. And then again, just like rent, as they use that insurance every month, it turns into an expense. And it doesn't matter if they file a claim or not. It doesn't matter if they have any insurance-related claims. All that matters is just that the time went by. They had the policy, right? The policy covered a year. So as time goes by, it's considered to have been used, became an expense. Just like with the rent, right? If you rent a building, but then you decide to go on vacation for the whole month and you weren't in the building, well, you still used the rent, right? Even though you weren't there. So insurance works the same way. All right, and what else? Also, let's say you get a utility bill. So you get a bill from the electric company. That tells you that you have an expense, that you use some electricity, right? And you can count that as an expense because it's already occurred, even though you haven't paid for it yet. So again, the period in which the expense or the revenue occurs can be different from when the dollars change hands. Right, so these are examples of adjustments related to expenses. Questions? Is that a question?
Yeah.
Oh, yeah, okay.
So for like the utility bill, you wouldn't record it until you get the bill?
Right, because you don't know what to report, right? I mean, you could look on their website, maybe, before you actually receive the bill in the mail or by email. But still, that's kind of the same thing. Once a statement has been created that tells you how much the expense is, that's when you can record it as an expense. Whether you see the bill online or you receive it in the mail, you know what the expense is, right? And then you record it. Good question. Okay, we already talked about the revenue recognition principles. Do you remember the concept of an unearned revenue? Who remembers what unearned revenue is?
That only promise to do work.
Yes. Is that what you're gonna say over there? Okay, exactly. So somebody's paid you already for a product or service you haven't provided, right? So you got the money, but you can't count it as revenue because you haven't actually provided the product or service. And what type of account is unearned revenue? Liability. Yes, right? Because we owe them the work. So that is another example where the dollars have changed hands because we got paid before we actually earned them, right? So later, once we do the service or provide the product, at that time, the unearned revenue will go away and it's earned into actual revenue. So the liability will go down, revenue will go up.
And is that an adjustment that you become remote?
It is. That is an adjustment as well. Okay. So now this is an adjustment related to revenue as opposed to an expense. Okay, we already talked about all of that. So remember the concept of an original source document? Sometimes you'll get a document that will tell you information you need to put into your accounting records. Well, these adjusting entries, you don't necessarily have a document to tell you it's time to do it. So as an accountant, you have to know, okay, we got paid in advance for this product, but we didn't provide the product until today. Now that we provided the product, we need to remember, okay, we have to go in and do the adjusting entry. There wasn't a specific document to tell us that. Now, I would imagine most accounting software programs probably have a way to remind the accountant. But if you're doing it manually, it might be something where you just have to make that connection and say, oh, yes, I need to go back in and make the adjusting entry. Okay, and that gets us to the two types of adjusting entries. I will wait till later to teach you a trick that you can use to keep them apart. We'll get to that a little bit later, but I will go ahead and just explain the difference. We have deferrals and we have accruals. So a deferral is when the money changes hands now, but the related action hasn't happened yet. And accruals are the opposite. The action happens now, but the money has not yet changed hands. Okay? And when those two parts, the money changing hands and the action, if they happen in different periods, that's when an adjustment's going to have to be made. Right? Question? Yep.
Is that referral pretty much kind of like prepaid entry? Oh, not.
Yes. Yeah, you could look at it that way.
Or unearned expense actually.
Yeah, so a deferred expense would be one where we paid for it, but it hasn't, we haven't actually used it yet. And a deferred revenue would be the customers paid us and we haven't provided the service or product. Yeah, prepaid is a good way to look at it. Okay, very good. Okay, so that's what it says here, prepaid, right? Deferrals are prepaid. All right, and it does apply to both expenses and revenue. So here are some examples of prepaid expenses. Supplies. We've talked about that, right? You buy some supplies. And I mean, it's possible, to be honest with you, it is possible if you're, let's say, your supplier has said, you don't have to pay us for 30 days. It's possible you might use up those supplies and count them as an expense before you ever paid for them, okay? But that's unlikely. Usually when companies buy supplies, they're buying a lot of supplies for a long period of time, and they're probably going to make the payment first, and then only count those supplies as expenses later, okay? So normally supplies would be prepaid. Buy them first, count them as an expense later. As I mentioned, depreciation on long-term assets. Buy the asset and then over time depreciate it, so it becomes an expense later. Same thing with insurance and rent, as we've discussed. Okay, so these are all common accounts where there's going to need to be an adjusting entry. Then unearned revenues, as we've discussed, would be where our customer paid us and we need to provide the product or service. Okay, accruals. So accruals also can relate both to revenues and expenses. So some examples would be interest and services completed. So if we have earned some interest on a loan we made to somebody, we made a loan to them, there's some interest that has accrued that they owe us, but they haven't paid us yet for the interest. That would be an accrual. Or again, if we've done the work, but not yet been paid, that's also going to be an accrual. Then we have accrued expenses. We have interest expenses, taxes, and salaries. These are things where you don't pay them every day. For example, a lot of companies pay their employees every 2 weeks, right? So during that 2-week period that the workers are working and not getting paid, we're keeping track of how many hours they worked, right? So we're accruing that expense. The expense is actually happening, but we're only going to pay for it after the pay period ends, right? So the dollars will change hands later. Same thing with taxes. Companies have to pay income taxes, property taxes, sales taxes, payroll taxes, and probably other taxes too. But they accrue over a period of time, typically monthly or quarterly, and then the company sends in the tax payment. Same thing with interest on a loan that the company took out. If the company borrows money, interest is constantly accruing, and then every once in a while the company has to make an interest payment. Okay, so the action of the expense is happening first, then the money is trading hands later. Right? Any questions? I know I've already said some of the same things multiple times, but that's the nice thing when we have a chapter that's not as fast-paced as the last couple, is repetition. Helps these ideas sink in. All right. So here we have a scenario where this guy's doing some accounting using the accrual basis. What was the accrual basis of accounting as opposed to the cash basis?
Record everything would have happened.
Okay. Under the accrual method, which is what most companies use, is you record the sale when it happens, you record the expense when it happens, not when the dollars change hands. If you were using the cash basis of accounting, which again only applies to small businesses, very small businesses, and nonprofits, then you don't have the issue of adjustments, because you're not counting that action until the money does change hands, right? So it's only in the accrual method of accounting, which is the one that most companies use, that we do have to make adjustments. So he is using the accrual method, and he noticed a few inaccuracies on the unadjusted trial balance. So step 4 of the accounting cycle, he listed out the balance of every account, and he sees there are some problems there. Okay, one difference is the supplies account. The amount on paper does not match the value of supplies inventory that are still available. So in other words, he looks at the supplies and says, okay, we've got $500 worth of supplies in the supply cabinet. But I show $700 of supplies in the supplies account, my accounting records. Why might that be that we have $500 of supplies in the supply cabinet and $700 in the accounting records? Yeah, we use $200 worth of supplies and we just haven't made that adjusting entry yet. So now we need to do that adjustment so that the accounting records match what's in the storage cabinet or supply cabinet. The other one says interest earned from the bank account, and he didn't show anything recognizing those earnings. So for example, maybe he got a bank statement that says we've earned some interest. But if he didn't go in and make the adjusting entry, then the accounting records are going to be wrong. Okay, that's why we have to make adjustments. All right, here's an unadjusted trial balance. So don't worry about the details. We're going to see some adjustments that are going to now be made, right? Because the unadjusted trial balance is before any adjustments were made, right? So what step is this? The step when we're making adjustments. 5? Yes, sorry. So here's an adjustment. Well, actually, no, this is a purchase. We bought some supplies, we paid cash. Okay, but then the adjustment is down here. Now we used some supplies, $150 worth, and now we count that as a supplies expense. So notice that when we purchased supplies, we debited the supplies account, right? And why does that make sense that we would debit supplies when we purchase them?
The increases.
Yeah. Our supplies increased. Supplies are an asset. We know assets are part of deal, and the deal accounts get recorded in the debit column when they go up, right? So it makes perfect sense. Then when we make the adjustment, we're crediting supplies, right? Why are we crediting supplies?
Because we use.
Was that out? It went down? Yeah.
Cash.
Yeah, that asset went down. We used $150 worth of supplies, so that asset decreased, so we credit that asset account. But we know we have to debit something, right? And that's where we can now count it as an expense. Is expense part of deal?
Yes.
Yes. Okay, so both assets and expenses are part of deal. But expense, when we debit it, it means the expense is going up, but what's happening to equity? Equity is going down, right? So in this case, we have equity going down and we have an asset going down. And if you remember from when we practiced this last week, that means our accounting equation is still in balance, right? So this is one adjustment. It's one you'll see multiple times. Debit supplies expense, credit supplies. Okay, any questions on this adjustment or any questions at all? Okay. All right. Here again, we would copy that information over to the ledger, and we sometimes use these T accounts to represent the ledger. So when we first bought the supplies, that was a $400 debit to the supplies account. When we used $150 worth, that's a credit to the supplies account, right? And that leaves us with the remaining $250 of supplies. Is that a debit balance or a credit balance? The supplies account. Debit, right? Because it's on the left side. Okay. All right. Oh, notice in that adjusting entry, there was a balance sheet account and there was an income statement account, right? Like I told you, there's always going to be one of each in the adjusting entries. All right, so depreciation, we'll in a future chapter, we'll get into how to calculate depreciation. So we won't have to worry about that for now. But remember that depreciation is on long-term assets, and that's how we get to take an expense for those assets. And usually it happens over a long period of time. So in this case, we bought $2,000 of equipment. We're depreciating $500 per year. So at the end of every year, we have to remember to record $500 of depreciation on that asset until it is fully depreciated. So in other words, the $2,000 cost of the asset, we will be able to count as a $2,000 expense. We just have to do that over multiple years. And the way we record that depreciation expense is a debit to depreciation expense, and then a credit to accumulated depreciation. Now, the reason we do it this way is, do you remember the cost principle that says that when you buy an asset, you record that cost and then that cost doesn't change? Doesn't matter if the market value changes for the asset. It doesn't matter if you take depreciation, that cost always stays the same. So if you look at the equipment account, it's always going to show $2,000 because that's what we originally paid. But if you wanted to figure out what is the book value of that asset, what is it officially worth, it would be the original cost minus whatever depreciation has accumulated. So we have to keep track of that in this accumulated depreciation account. And you see that we have a specific accumulated depreciation account for this asset equipment. Can you all handle an advanced concept? Yeah, okay, I like that confidence. So we know depreciation expense is an equity type of account. Expenses decrease equity, right? We know that. What type of account do you think accumulated depreciation might be? It's an asset type of account. But remember, I told you assets are part of deal and they increase on the debit side, right? So why is this account where our accumulated depreciation is increasing, why are we recording it on the credit side? Because it's what's called a contra asset account. It's an asset type of account that reduces the value of our asset. Just like expenses are equity accounts that reduce equity, and dividends are equity accounts that reduce equity, this is an asset account that reduces the value of the asset. Okay? If you don't quite grasp that right now, that's okay. The nice thing is anytime we're depreciating, it's going to look like this. For the entire course, it will always be debit to depreciation expense, credit to accumulated depreciation. It does change when you get to managerial accounting, but in financial accounting, it will always look like that. Okay, so that's really all we need to know about depreciation for now. Any questions? All right, again, we would transfer those two transactions to the ledger, and you see there's a balance sheet account and an income statement account. Okay, I'll go a little quicker on some of these other ones. So we paid $4,500 for insurance for 6 months. And at the end of the month, we've now used 1 month worth of insurance, right? So here's the original purchase where we bought the insurance. And what is 4,500 divided by 6? It's up to $750, right? So after 1 month of this 6-month policy, we've now used $750 of that insurance. So we have an insurance expense, which we debit, and our prepaid insurance gets a credit because it's an asset going down, right? Again, we would record that over to the ledger. So we started by buying $4,500 of insurance. We, after 1 month, reduced that by 1 month's worth, and that brought us to our new balance, right? Okay, here's another example. We paid for 4 months of rent, paying $8,000. That's how much per month? 2,000, right? $8,000 divided by 4 months to 2,000. So here's where we bought the rent. I guess you don't say bought rent, right? Here's where we paid for the rent. And after 1 month, we can count 1 month as a rent expense, and we would reduce our prepaid rent by 2,000. Copy those over to the ledger. What is the balance now in our prepaid rent account after the first month? 6,000. What's the balance going to be after 3 more months go by?
0.
0. Will all be used up. Exactly. Okay. All right. We collected a retainer of $48,000. So have we talked about retainers at all? This is a concept that lawyers use when they get paid in advance for their services. They call it a retainer. So it's really unearned revenue. In this case, they just stuck the word fee in there because the lawyer charges a fee. So they're calling it unearned fee revenue. So the lawyer got paid $48,000 for work that they've not yet earned, right? We're done. Then 40% of the work has now been done. So at the end of the period, they would go ahead and record that. You take 40% of 48,000, I guess it comes out to 19,200. And so that's how much unearned fee revenue now goes away, right? And becomes fee revenue because now they've earned it. What type of account was unearned fee revenue? You said it earlier. Liability, yeah, exactly. It's a liability. And does it make sense we would be debiting this liability? Liabilities increase on the credit side, right? Because they're not part of deal. When they go down, it would be a debit, and that's what's happening here. What type of account is fee revenue? Equity? What's that? It's equity. Yeah, fee revenue. Anytime you see revenue, except for unearned revenue, any other time you see revenue, it's equity. And so it would increase on the credit side because it's also not part of deal, right? So we have a liability going down and revenue, which is equity, going up. So it makes sense. Transfer those over to the ledger. Again, we have the original unearned fee revenue minus the amount that they earned. They have a debit balance or credit balance. Credit. And that makes sense, right? Because liabilities, not only do they increase on the credit side, they would normally have a credit balance. Okay, anything need clarification? Yeah, let's keep going. We're on a roll here. See how we're doing time-wise. Okay. All right, a company has an outstanding note receivable for $100,000. What does that mean? They have an outstanding note receivable.
We gave a loan to somebody.
Made a loan to somebody and they haven't gotten that money back yet, right? Okay, so they can expect to receive $100,000. In the meantime, they're charging interest of 5% per year. 3 months have gone by. So now the company, I mean, some companies calculate interest daily. Some might do it monthly, some might do it quarterly. In this case, the company every 3 months figures out how much interest it has earned from this loan. So they take a look, and what they do is they take the amount that is owed to them, the amount of the note, times the annual interest rate. And because that's annual and we're only charging for 3 months, we then need to multiply it by 3 divided by 12, right? Because we're only charging interest for 3 of the 12 months. So this is the formula that you will use anytime you need to figure out how much interest to charge for a certain period of time. It's always going to be principal times the annual interest rate times the number of months divided by 12. And we can use that same formula if we owe interest. We can calculate how much we owe by taking, again, the amount that we owe times the interest rate times the number of months divided by 12. So in this case, it comes out to $1,250. So now on top of the $100,000 that the borrower owes us, there's also interest receivable of $1,250. So we have a note receivable for the original amount and interest receivable that we also can expect to receive payment for. And because the time has already passed, right? This is for 3 months that have already gone by. We can already count that as revenue. We have already earned that interest. Interest receivable is an asset, just like notes receivable and account receivable. Interest revenue is another form of revenue. So it's also an equity account, and it would increase on the credit side. All right. Questions? All right. Again, copied over to the ledger, balance sheet account, income statement account. Company performed landscaping services, $1,500, but they've not yet received payment. Okay, so here they have an account receivable, right? That's what the customer owes them. And they've already done the work, so it's counted as revenue. So here, revenue gets credit, accounts receivable gets debit. So we are going to have to make an adjustment at some point. What's the other transaction that's going to happen in the future? We've done the work, we didn't get paid, so what's going to happen in the future?
Cash.
We're going to get paid. Exactly, right? At that point, we'll get cash, and then accounts receivable will go down. Okay, company accrued $300 of interest during the period. This is interest that they owe. Okay. So in this case, that's an expense because the period has already gone by. So you go ahead and count that as an expense, even though we haven't paid for it. Because we haven't paid for that interest, we have an interest payable. What type of account would that be? Exactly. Payables are always liabilities, and they increase on the credit side. Okay. We record those to the ledger. Here we have accrued some income taxes for the month, $9,000. That would be nice to have a business making so much profit that you owe $9,000 a month in income taxes, right? That's it's not too bad. It's a good problem to have, as they say. So that is similar. We already have the expense because we already, owe those taxes. And we haven't paid them, so we have an income tax payable, also a liability. Okay, copied over to the ledger. We've got some employees. They've earned $2,500 each. There are 5 of them. So you do the math, that comes out to $12,500 we owe these employees. They've already, this is for a period of time that's already gone by. So that expense already exists, but we haven't paid them yet. So we have a salaries payable, right? Which is also a liability. Copy it over to the ledger. All right. Are those enough examples? There were like 20 examples there. Let's see how well we understand the concepts here. Let's see. Okay. Let's do this page together, and then the second slide I'll have you do individually here. Let me try to make it a little bigger. There we go. Okay. Okay, so there are 3 adjusting entries. See them down here? We have 3 journal entries. Each one is an adjustment. And what we need to do one by one, we're going to look at it and figure out which is the income statement account, which is the balance sheet account, and was there any cash involved in that transaction? I'm just gonna put 1, 2, and 3, okay? So the first one is supplies expense and supplies. Which of those two is an income statement account? Supplies expense, right? Because the income statement is revenue minus expenses. And then obviously the other one, supplies, is the balance sheet account. Why is supplies a balance sheet account? It's an asset, and assets go on the balance sheet. Was there any cash in this transaction?
Yes.
There was cash when we originally bought the supplies or paid for them, right? But in this transaction, we're just saying, okay, we've used some supplies, so the amount of supplies went down, and we're calling that a supplies expense, but there are no dollars changing hands in this transaction. How about this next one? Unearned revenue, is that an income statement or balance sheet account?
Balance.
It is balance sheet, right? Unearned revenue is a liability. And assets and liabilities go on the balance sheet. The service revenue, that's real revenue, right? Because it's been earned. That is an income statement account. Was there any cash in this transaction where we converted unearned revenue into service revenue? Nope. It just means we did the work. Again, the payment happened previously in the previous transaction when the customer paid us and we hadn't done the work yet. That's when the cash changed hands, but not in this transaction. Okay, next one, we have rent expense and prepaid machine rent. Which one goes under income statement account?
Rent.
Rent expenses, right? Prepaid machine rent goes over here. What type of account is that? Type of account is prepaid machine rent? This, more specifically, it's an asset. And was there any cash in this transaction? Nope. All we're doing is saying that, hey, time has gone by, so we've used up $1,200 of that prepaid rent, and we can now count that as a rent expense. The way you would know that there was cash in the transaction is one of the accounts would be cash. Cash would be getting either a debit or a credit. And we don't see cash listed in any of these three transactions, right? So with these adjusting entries, there was no cash in that transaction. Maybe in the previous or the subsequent transaction, there's cash, but not in these three. Right? Like, as I mentioned earlier, when we bought the supplies, yes, we probably paid for them then, right? But in this transaction where we're converting supplies that were used to a supplies expense, there's no cash involved. So go ahead, try to do the same thing here with these two transactions. And go ahead, work together and see what you come up with. Before I get to this slide, a miracle happened. I remembered that I said I would look something up, and I did. So, Yanette, you'd asked the question about if you're a privately held company, do you still have to do the same things? So, and I said, I wasn't completely sure about whether or not you had to report to the SEC. Well, I looked it up. And according to dummies.com, you know, it's probably reliable. The Dummies, I don't know if you know those books, but they're really well-written books that simplify complex concepts. So according to dummies.com, private companies must file financial reports with the SEC if they meet following criteria. If they have more than 500 common shareholders, they have $10 million in assets, they've made a public debt offering, then why would they be private companies? That's weird. They're also required to distribute their reports to a closed group of stakeholders and not required to share them with the public. So the answer is it depends. Right. I'm glad we cleared that up. All right, let's move on here. You are an accountant at a salon that uses the cash basis of accounting. And as a small company, you are allowed to do that. But you're considering maybe switching to the accrual method. So instead of counting a sale when you get paid, you will count it when you provide the service, even if you didn't get paid. And instead of counting an expense when it happened, you'll count an expense. No, instead of counting an expense when you paid for it, you'll count it when it happens, even if you haven't paid for it, right? So that would be the difference if you switch to the accrual method. Why might you choose to do it or not do it? What are the pros and cons of switching to the accrual method? It is more work, right? It's kind of easier if you just count a sale when you get paid. You don't have to worry about making adjustments if you got prepaid or something like that. So the cash basis is a little simpler. The accrual basis would be more work. But what would be a benefit of the accrual method? Why do companies use the accrual method?
Just you know exactly what you and what else.
Yeah, well, with your profits and losses, it gives you a better idea of your profits and losses because you count all of your sales, whether they've been paid for or not. You count all of your expenses, whether they've been paid for or not. So it gives you a clearer picture of your profitability, but it means that you have to track your cash flow separately because they're two separate things. Okay. So the benefit of the accrual method, you get a better picture of your profits and losses. The downside is it is more work because you have to make adjustments. Okay. Oh, shoot. I was so excited that I remembered to look that up. I forgot to fix my remote. Okay. Here we have a whole list of transactions. We see our unadjusted trial balance. And these are all the transactions that led to this unadjusted trial balance. Okay, but that's just for reference. Then there are some adjustments, right? This is now step 5, making adjustments. So we see 5 adjustments, and we'll just go through them one at a time. In the first one, well, you tell me, what happened? Why did we make this adjustment? Yeah, we use some supplies, right? So we are going to reduce our supplies and count them as a supplies expense. Notice the impact is our assets went down because we don't have those supplies anymore. And equity went down. Why did equity go down? Because of the expense, right? Remember that expenses reduce equity. Okay, good job. And here's another one. We took some depreciation on equipment. As I told you, that's always going to be a debit to depreciation expense and a credit to accumulated depreciation. Let's look at the impact that has on the accounting equation. Why did equity go down? Because of the expense, once again. Why did assets go down? Yeah, remember I told you that accumulated depreciation is a contra asset account, so it reduces the value of our assets, which is why we record it on the credit side, and you see it reduces our assets. Okay. we did $600 worth of services that previously we'd already been paid for, but we hadn't done the work. So now our unearned revenue goes down and service revenue is going up, right? Unearned revenue is the liability going down. And the service revenue is the equity going up. Now, if we have a liability go down and equity go up, is our accounting equation still in balance? Yeah, it is. It is, because remember, the equal sign is here. So if we have $600 going down and $600 going up on the same side of the equal sign, they balance each other out. Okay. Whereas if it's on opposite sides of the equal sign, like an asset and equity, then they either both have to go up or both have to go down. Right, another transaction. We find $140 of interest that we've earned and have not collected. So we have interest receivable. Our customer or our borrower owes us that money. And interest revenue because we earned that interest. Interest receivable is what type of accounts? Asset, exactly. We see the asset going up. And then revenue increases our equity. Okay, and then another one, employees earn $1,500, so that's the salaries expense. Assuming these are salaried employees, some employees get an hourly wage, but these employees are paid a set amount, a salary. So that expense has gone up, and we have a salaries payable. Let's see. Why is equity going down? Again, from the expense, right? And why are liabilities going up? Yeah, that payable means we owe it. It's a debt. And again, because these transactions are on the same side of the equal sign, one going up and one going down just balances it out, and we're still in balance. Okay, so now that we've made these adjustments, let's see if each of these is a deferral or accrual. Okay, I told you I have a little trick for remembering what's a deferral and what's an accrual. Let's get to that now. Deferral starts with D, right? And dollars starts with D. So in a deferral, the dollars change hands first, and the activity, either the expense or the revenue, happens later. Dollars are first, the action is later. With an accrual, which starts with an A, the activity happens first, and the dollars change hands later. To me, that is the easiest way to memorize the difference between an accrual and a deferral. The dollars happen first, and then the action happens in a different period, which would be a deferral, or does the action happen first, then the dollars change hands in another period? It would be accrual. So let's use that little tip here and see if we can answer these questions. Company recorded supplies usage for the month. So if we think about that case where they had bought the supplies and hadn't used them yet, is that a deferred expense or an accrued expense? It's deferred because they bought them first, right? They paid, and then the activity of using them happens later. Yes, deferred is the correct answer. How about this second one here? A customer paid in advance for services. Did the dollars happen first or the activity? Yeah, the dollars happen first. So again, it's a deferral. The third one, the company recorded salaries that had been earned but had not yet been paid. That's accrual, right? because that expense happened first before the employees got paid, right? And an expense is an activity, dollars are happening later, so accrual is right. So if you can just remember that little mnemonic device there, I think it's going to make this chapter a lot easier. Does anyone have questions? Okay. All right, let's cover a little bit more and then we'll take a break in 8 minutes. All right, here's a transaction. So they discovered $100 of supplies had been used. As we've seen before, that's a supplies expense. And our supplies go down, right? And so we record that then to the ledger. Nothing new there. We took some depreciation on our equipment. Again, we've seen this before. Debit to depreciation expense, credit to accumulated depreciation, and then those get copied to the ledger as well. We did $600 of services that had been paid for previously. Okay, so that means when we got paid and hadn't done the service at that time, we had unearned revenue. But here, we've now earned it. So unearned revenue is getting reduced, right? And we see the remaining balance in unearned revenue. We can now count it as revenue because we've actually earned it. And it gets recorded as a credit in the revenue account. Okay. Just checking, was there any cash involved in this transaction? No. There was cash when the customer originally paid us, but that was a different transaction. Okay. And we earned $140 of interest. The customer, well, let me ask you, has the customer paid us? No. That's why we have interest receivable. And we have already earned it, so we have interest revenue, right? We earned it because the time went by, but the customer hasn't paid us yet. Okay, then we have some more employees earning salaries. Have we paid them? Nope. And we know that because we have a salaries payable entry. Okay. So now if we took all of the previous transactions from the unadjusted trial balance and we updated it with these adjustments, like, what were some of these that were adjustments? Look at one. So we have the salaries expense and salaries payable. Salaries payable, we see that adjustment entry there. Salaries expense, we see that 1,500 over there too. So my point is, we took the previous accounts, but we had to adjust them, right? And once we've adjusted them, the balances change in those accounts. So then we have to take these new balances from all the asset accounts, all the liability accounts, and all the equity accounts, and we put them into our adjusted trial balance. But we've already made the adjustments, right? We make the adjustments in the journal, we copy them to the ledger, and then we just take the balances from the ledger to make the adjusted trial balance. Let's see, use the ledger balances to prepare an adjusted trial balance. Okay, and that's what that looks like right here, right? So we're just taking the balance from every account. If it's a debit balance, it'll be in the debit column. If it's a credit balance, it'll be in the credit column, right? And do you remember on these trial balances, which accounts we start with? Assets. And then what do we follow that with?
Liabilities.
Liabilities. Then we get to the equity accounts, which are common stock, dividends, revenue, and then expenses. Always in that order. Now, if there's an account that has a zero balance, we just leave it off. Right? There's no point in putting it on the trial balance if it has a zero balance. But if it has any other balance, whether it's debit or credit, you would record it, and then you would add up all the debits, add up the credits, and make sure they match. Okay, so that is preparing the adjusted trial balance. Okay, I don't need to cover anything else there. Oh, that's a better, you can see it up a little closer. Right? Any clarification? All right, so then we would be at step 7. All right, step 5 was making adjusting entries. Step 6 is making our adjusted trial balance. And step 7 would be actually making the financial statements. And we know we always start with the income statement, then we make our statement of retained earnings, and you probably also want to make your statement of stockholders' equity at that time. But you need that retained earnings to make the balance sheet. So that's what we will practice more on Wednesday. Another thing we're going to get into in this chapter is you can make in a spreadsheet program like Excel, you can make one spreadsheet that shows you your trial balances, your adjustments, your income statement, and your balance sheet all on one spreadsheet, which would be really handy. It's not a required step, but it would be something as an accountant where, hey, if you needed to look it up really quickly, you could just go to that spreadsheet and all that information is right there. You don't have to go run a report or pull up an individual report. Okay, so that's what we have to look forward to. Let's see, we still have a minute or two left. Okay, so we can do this real quickly. So we're going to look through this and figure out which accounts, which financial statements these accounts will go on. So we know we start with the assets, right? We have current assets, and we also have a long-term asset, and we have a contra asset, right? Accumulated depreciation, I told you, is a contra asset account, and notice that it has a credit balance, right? Because it reduces the value of our assets. Which financial statement will these asset accounts go on? The balance sheet. Then we have our liability accounts. Accounts payable and salaries payable and unearned revenue. Those are all liabilities. Notice they all have a credit balance. Which account do they go on? And which financial statement do they go on? Also the balance sheet. Excellent. Same thing with common stock. That will go on the balance sheet. Dividends. They go on the retained earnings page. Then we have our revenue and expense accounts. Where do those go? Yes, the income statement, right? Okay. So I think that's enough for now. So let's go ahead and take our 10-minute break, and then we'll work on the exercise set.